Every month, you're losing thousands to mortgage interest. But you can stop this strain on your finances without sacrificing your current lifestyle. By the end of this video, you will know how to build an automated financial system. This setup legally minimizes your daily mortgage interest simply by rerouting how your cash flows in and out of your accounts. This flowchart introduces the 3 non-negotiable tools we need to build this system. You need a standard Australian mortgage, a 100% linked offset account, and a credit card that offers an interest-free period. Banks rely on customers keeping these financial products separate. When these tools are configured correctly, they work together to ensure no part of your income sits idle while you owe money on your home. Step number 1 is confirming your foundation. Log into your online banking portal and check your daily transaction account. You must verify that it is explicitly classified as a 100% offset account and that it is directly linked to your mortgage. Next, check the terms and conditions of your credit card. You are looking for a feature called an interest-free period. This allows you to defer payments for up to 55 days without penalty. To confirm your setup is active, look at your banking interface. You should see your offset account balance listed directly alongside your home loan balance on the same screen. This split-screen diagram shows exactly why account types matter. On the left is a standard savings account, which earns interest that you have to pay taxes on. On the right is a true offset account. It does not earn interest. Instead, the balance directly reduces your principal debt, providing a tax-free financial benefit. Establishing this correct account structure prevents tax leakage. It ensures every dollar you hold works at maximum efficiency to lower your debt. Step 2 requires updating your payroll details with your employer. From now on, 100% of your salary and any other external savings must be deposited directly into your offset account. This formula illustrates our core rule. Banks calculate mortgage interest daily. With a $500,000 mortgage and a $50,000 offset balance, you are only charged interest on the $450,000 difference. The exact moment your paycheck lands, your daily interest charge drops in real time. Do not split your income across multiple separate budgeting accounts. Any idle cash sitting outside of the offset account is wasted potential. By consolidating all your liquidity into this single offset bucket, you guarantee a continuous daily reduction of your largest debt. Step 3 is changing how you spend. You must stop using your debit card immediately. From today forward, route all your daily, weekly, and monthly expenses exclusively through your credit card. The mechanical purpose behind this is simple. By paying with credit, the actual cash meant for those expenses remains untouched, sitting safely in your offset account. This 55-day timeline compares balances during an interest-free period. Your offset balance stays high and flat, preserving your discount, while spending slowly accumulates on the credit card. During these 55 days, your unspent cash essentially earns a tax-free return equal to your mortgage rate. However, the credit card is purely a routing tool. Any unplanned overspending or lifestyle creep shatters your mathematical advantage. Used correctly, the credit card acts as a temporal buffer. You force the bank to float your living expenses for free, while your actual cash fights your mortgage. Step 4 closes the entire loop safely. Log into your banking app and set up an automatic direct debit from your offset account to your credit card. The timing and amount here are critical. Set the transfer to trigger 1 to 2 days before your due date and configure it to pay the full statement balance. This automation ensures your credit card balance resets to 0 right before the interest-free grace period expires. You completely avoid paying any credit card fees. If you pay only the minimum or carry a balance, you will incur massive credit card interest rates that instantly wipe out months of mortgage savings. But as this looping animation shows, paying the balance in full clears the debt and seamlessly resets your system for the next month. Automation is your ultimate safeguard. It removes human error and guarantees the strategy loops indefinitely without triggering a single penalty. Your system is now fully constructed. Your income actively attacks your interest, your expenses are deferred for free, and your automated repayment loop protects you from fees. This setup also keeps your funds accessible. Unlike making extra loan repayments, which can be difficult to withdraw, money in an offset account is available for immediate use during emergencies. This is vastly superior to traditional savings. The tax efficiency of reducing your daily debt far outweighs earning taxable interest in a standard bank account. Your next step is to monitor your spending patterns meticulously for the first 2 months. Verify that the automated flow is triggering exactly as planned. By linking these everyday banking tools, you have established a workflow that uses your salary and daily spending to shrink your largest debt as fast as possible.